Reserve Bank of India is expected to reduce its benchmark interest rate for the third time in a row following the Monetary Policy Committee meeting today. A more growth-friendly, accommodative stance is likely to be continued with, meaning more rate cuts are likely to follow. Now remember, the RBI's MPC began its meeting on June 4th, 2025. Governor Sanjay Malhotra will announce the outcome of the two-day deliberations today. Now, while a 25 basis point cut in the repo rate to 5.75% is largely on expected lines, SBI research suggests a 50 basis point could be coming in as well. Now, investors will be closely following what RBI's guidance on inflation and GDP growth forecast for this financial year, FY26, are likely to be, along with the risks on the horizon. And these risks range from some domestic and some external risks, from monsoon in India to oil prices in the world and other external threats which may be emanating from Russia's promised retaliation on Ukraine to the Trump-induced trade wars. Now, what does it mean for you, the consumer? Well, for the loan seeker in India, hopes are pinned on the RBI to direct banks and NBFCs to transmit the lower rates to end consumers very quickly. Now, remember, what usually happens is that every time the central bank hikes interest rates, banks are quick to offer that to consumers, but the reverse of that is not always true. Let's get you live visuals of RBI Governor Sanjay Malhotra.
Has somewhat ebbed since the MPC met in April in the wake of temporary tariff relief and the optimism around trade negotiations. However, it is still high to weaken sentiments and lower global growth prospects. Accordingly, global growth as well as trade projections have been revised downwards by multilateral agencies. Moreover, the last mile of disinflation is turning out to be a little more protracted. As growth-inflation trade-offs is becoming more challenging, monetary authorities are charting out a more cautious and carefully calibrated policy trajectory. Looking beyond the near term, growing economic and financial fragmentation is reshaping the global economy. Besides complex interconnections with the financial system, elevated debt levels, and growing influence of frontier technologies like AI are raising financial stability concerns. Amidst heightened volatility in capital flows and exchange rates, coupled with constrained policy space, central banks of emerging market economies have a tougher task to stabilize their economies against global spillovers. In this global milieu, the Indian economy presents a picture of strength, stability, and opportunity. First, strength comes from the strong balance sheets of the five major sectors: corporates, banks, households, government, and the external sector. Second, there is stability on all three fronts: price, financial, and political, providing policy and economic certainty in this dynamically evolving global economic order. Third, the Indian economy offers immense opportunities to investors, both domestic and foreign, through 3Ds: demography. We have a high proportion of the working age population which is growing. It is becoming more literate, it's becoming more educated, more skilled, urbanized. Then there is the third D, the second D, the digitalization. We have very advanced and sophisticated public digital infrastructure. And domestic demand is the third D, which we are talking about over here, which is very important given the trends of deglobalization. This 5x3x3 matrix of fundamentals provides the necessary core strength to cushion the Indian economy against global spillovers and propel it to grow at a faster pace. We are already growing at a very fast pace. 6.5% is the highest, not only last year amongst major economies, but even in the last decade. Of course, we aspire to grow at a higher rate, and we are making all efforts in our vision of a Viksit Bharat by 2047. I now come to the Monetary Policy Committee decisions. The Monetary Policy Committee met on the 4th, 5th, and 6th of June, that is today, to deliberate and decide on the policy repo rate. And after a detailed assessment of the evolving macroeconomic and financial developments and the economic outlook ahead, the MPC decided to reduce, which is widely expected, the policy repo rate under the liquidity adjustment facility by 50 basis points to 5.5%. I repeat, the reduction recommended by the MPC is for 50 basis points to 5.5%. This is with immediate effect. Consequently, the standing deposit facility rate, which is the STF rate, shall stand adjusted to 5.25%. And the marginal standing facility, MSF rate, and the bank rate shall stand adjusted to 5.75%. I shall now briefly set out the rationale for these decisions. Inflation has softened significantly over the last 6 months from above the tolerance band in October 2024 to well below the target. The latest numbers are 3.2%, with signs of a broad-based moderation. The near-term and the medium-term outlook now gives us confidence of not only a durable alignment of headline inflation with the target of 4%. You are aware we had earlier projected for this year an average inflation of 4%, as excluded in the last meeting, but also the belief that during the year it is now likely to undershoot the target at the margin. While food inflation outlook remains soft, core inflation is also expected to remain benign, with easing of international commodity prices in line with the anticipated global growth slowdown. The inflation outlook, therefore, for the year is now being revised downwards from our earlier forecast of 4% to 3.7%. Growth, on the other hand, remains lower than our aspirations amidst challenging global environment and heightened uncertainty. Thus, the MPC felt that it is imperative to continue to stimulate domestic private consumption and investment through the policy levers to step up the growth momentum. This changed growth inflation dynamics calls for not only continuing with the policy easing, but also the MPC felt front-loading the rate cuts to support growth. Accordingly, the MPC voted to reduce the repo rate by 50 basis points to 5.5%, as already mentioned. After having reduced the policy repo rate by 100 basis points in quick succession since February 2025, the Monetary Policy Committee also felt that under the present circumstances, monetary policy is now left with very limited space to support growth. Hence, the MPC also decided to change the stance from accommodative to neutral. From here onwards, the MPC will be carefully assessing the incoming data and the evolving outlook to chart out the future course of monetary policy in order to strike the right growth-inflation balance. The fast-changing global economic situation too necessitates continuous monitoring and assessment of the evolving macroeconomic outlook. I will now come to the assessment of growth and inflation. First, growth. The provisional estimates released by the National Statistical Office placed India's real growth in 24-25 last year at 6.5%. During 25-26 so far, domestic economic activity has exhibited resilience. Agriculture sector remains strong with a very good harvest in both the Kharif as well as Rabi cropping seasons. The supply of major food crops is comfortable. The reservoir levels remain healthy. The highest procurement of wheat in the last 4 years provides a comforting stock position. Industrial activity is gaining gradually, even though the pace of recovery is a little uneven. Services sector is expected to maintain momentum. PMI services stood strong, as you are aware, at 58.8 in May 2025, indicating a very robust expansion in activity. On the demand side, private consumption, which is the mainstay of aggregate demand, about 56% of the total GDP, remains healthy with a gradual rise in discretionary spending. Rural demand remains steady while urban demand is improving. Investment activity is reviving as reflected by high-frequency indicators that we track. Merchandise exports recorded a strong growth in April 2025. Of course, this could be because of some front loading, but this is after a lackluster performance in the recent past. Non-oil, non-gold imports posted a double-digit growth, reflecting buoyant domestic demand conditions. Services exports continue on a very strong growth trajectory. Both the last month's figures have been quite robust. Going forward, the outlook for agriculture sector and rural demand is expected to receive further impetus by the expected above normal southwest monsoon rainfall. On the other hand, sustained buoyancy in services activity should nurture revival in urban consumption. The healthy balance sheets of banks and corporates, governments the government's continued thrust on capex, elevated capacity utilization, improving business optimism, and easing of financial conditions should help further revive investment activity. Trade policy uncertainty, however, continues to weigh on merchandise exports prospects. The conclusion of the free trade agreement with the United Kingdom and the fast progress that is being made in our negotiations with other countries, on the other hand, should provide a fillip to trade. Spillovers emanating from protracted geopolitical tensions and global trade and weather-related uncertainties pose downside risks to growth. Taking all these factors into consideration, real GDP growth rate for this year 25-26 is projected at 6.5%. We continue with our earlier forecast with Q1 at 6.5, Q2 at 6.7, Q3 at 6.6, and Q4 at 6.3%. The risks are evenly balanced. I will now move to inflation. CPI headline inflation continued its declining trajectory in both March and April. The headline inflation moderated to a nearly 6-year low, in fact 69 months to be precise, to 3.2% in April 2025. This was led mainly by food inflation, which recorded the 6th consecutive monthly decline. Fuel group, which had been earlier witnessing deflationary conditions, there was a reversal of the deflationary conditions, and it has recorded positive inflation prints in the last 2 months of March and April. This is partly because of the hike in LPG prices. Core inflation remained largely steady and contained during March and April, and this is despite the increase in gold prices, which exerted an upward pressure. The outlook for inflation provides towards benign prices across major constituents. The record wheat production and higher production of key pulses in the Rabi crop season should ensure adequate supply of key food items. Going forward, the likely above normal monsoon, along with its early onset, augurs well for Kharif crop prospects. Reflecting this, inflation expectations are showing a moderating trend, and this is more so for the rural households. Most projections point towards continued moderation in prices of key commodities. This includes crude oil, which is of critical significance to us. Notwithstanding these favorable prognoses, we need to remain watchful of weather-related uncertainties and the still evolving tariff-related concerns with their attendant impact on global commodity prices. Taking all these factors into consideration and assuming a normal monsoon, CPI inflation for the financial year 25-26 is now projected at 3.7%, as I mentioned earlier. This is a downward revision from our earlier forecast of 4%. We are projecting inflation for Q1 at 2.9%, Q2 at 3.4%, Q3 at 3.9%, and Q4 at 4.4%. The risks are evenly balanced. I'll now come to the external sector. With a moderation in trade deficit in Q4 24-25, alongside strong services exports and remittance receipts, the current account deficit for last year 24-25 is expected to remain low. We are yet to get the final figures. Furthermore, despite rising geopolitical uncertainties and trade tensions, India's merchandise trade remained robust in April 2025. As imports grew faster than exports, trade deficit, however, widened during the month, which is the month of April. Going forward, net services and remittance receipts are likely to remain in surplus, counterbalancing the rise in trade deficit. The current account deficit for this year, 25-26, is therefore expected to remain well within the sustainable levels. On the financing side, in 24-25, foreign portfolio investment to India dropped sharply to $1.7 billion as foreign portfolio investors booked profits in equities. Net foreign direct investment, FDI, too moderated. I would like to take a moment over here because there has been large and widespread commentary on this moderation of net FDI. Now, we look at net FDI primarily because of our concern regarding foreign exchange reserves, where the net becomes important. It's not only the net the inflows, but also the outflows, which actually lead to either an accretion or a depletion in the foreign exchange reserves. However, when it comes to investment, then it is the gross FDI which is actually important, and gross FDI last year actually increased quite sharply. 14% is a very robust growth that we had, $81 billion. And so India continues therefore to be an attractive investment destination, despite there being a moderation, as we are seeing, in net inflows, which is primarily because of rise in repatriation, which is again a very good sign of a maturing market, where foreign investors can enter and exit smoothly, and at the same time higher gross FDI, which is again a sign of our large industrial and other companies going out and investing. So on the whole, gross FDI is high, which indicates that India continues to be a good and attractive investment destination. External commercial borrowings and non-resident deposits, on the other hand, witnessed higher net inflows compared to the previous year, as on May 30, 2025, India's foreign exchange reserves stood at $691.5 billion. These are sufficient to fund more than 11 months of goods imports and about 96% of external debt outstanding. Overall, India's external sector remains resilient as key external sector vulnerability indicators continue to improve. We remain confident of meeting our external financing requirements.
All right, and that's the big breaking news coming this morning. It's not a 25 basis point cut, it is a 50 basis point cut. The new interest rate, the repo rate, key lending rate announced by RBI Governor Sanjay Malhotra now stands at 5.50% from 6% earlier. Remember, most economists were expecting just a 25 basis point cut. SBI was one of the few research agencies which did say that perhaps a 50 basis point cut could be expected. Well, we have two economists joining us this morning to help and make sense of whatever we just heard from Sanjay Malhotra. Vivek Kumar, economist at QuantEco, and Mitali Nikore, founder and chief economist at Nikore Associates. Good morning, Mitali. Let me start by asking you, 50 basis point. It was there in the realm of imagination in the plausibility circuit, but for RBI governor to deliver 50 basis points, what does this really mean?
No, so I think, Kartik, this was highly required, and I'm actually quite happy that some of the agencies were mentioning 50 basis points. We were also mentioning 50 basis points as our projection, because the headwinds are going in that direction where the economy requires a little bit of an impetus at this point. We are trying to navigate a lot of global headwinds. We know that there's a lot of uncertainty in global markets with respect to the trade and value chains. We know that there's a lot of uncertainty in the global markets, even with respect to the price of the dollar. And I think for the stabilization of the US dollar exchange rate, for the stabilization and supporting the fiscal plan of the government, because remember, when these rates are lowered, it's also cheaper for the government to borrow. On open markets as well as in international markets. So, this creates an impetus for the government to also expand its borrowing and increase its spending. So, this is a huge impetus for the growth of the economy overall, and of course, improves consumer sentiment pretty much immediately, because it brings down your mortgage, it brings down your EMIs, it brings down.
Does it
and
really?
basically
Does
helping
it
the
really? And
consumer.
how soon, Mitali? We will come to that. But Vivek, I want to bring you into this conversation. I want to understand. Just in the last Monetary Policy Committee meet in the month of April, we heard the stance change from neutral to accommodative. And within a span of just 2 months, it has gone back to neutral. Now, what does this suggest? What are the fear, what are the threats that you think the RBI MPC is anticipating? Are these more internal threats or external threats? Because monsoon seems to be normal above normal, and that is not something which is likely to disrupt the flow of, the growth engines of the economy. But what we are perhaps expecting now is some sort of an aberration either in oil prices or Russia hitting back, or perhaps what Trump does on July 9th.
Hi, yes, thank you and good morning. So, first things first, I think it's a little bit of a surprise given the way the governor has chosen to upfront the monetary policy rate cuts. And in some sense, it's in line with market expectations. In some sense, it is not. So it is not, because obviously the consensus was expecting a 25. And it is in line with market expectations because the market was expecting this 50 basis points rate cut to be delivered between June and August. And thereafter, people were calling for, most of, at least the consensus was calling for pause. So what the RBI or the MPC has chosen is to upfront that monetary policy accommodation and deliver the 50 basis points right away rather than waiting until August. So what this leaves to the MPC then is that instead of turning neutral in August, they are turning neutral now.
Okay.
So
with neutral, Vivek, just for clarity of our viewers, with a neutral stance now, it does mean that going forward, depending on what happens in the world and domestically in India, there is a likelihood that RBI may choose to increase interest rates, hike interest rates again, right?
So technically, this is what a neutral stance would mean, that the probability of an interest rate hike or an interest rate cut should be roughly even. And the path forward should be completely dependent upon data.
Okay.
So whatever the data throws up in terms of positive or negative surprises, the MPC is likely to react to it and then act accordingly.
Fair enough.
This is what it means. But given the balance of risk coming from the global side, one could possibly make an assumption that the likelihood of a rate cut could be somewhat larger at this point in time than the likelihood of a rate hike. So this is where I would probably put it, that if at all there is some inkling that growth is either slipping below 6.5%, which RBI is projecting, or inflation is falling short of 3.7%, which RBI is again projecting, then you could have chance of a rate cut. So rate hike, uh, technically it is still there as far as neutral stances is concerned, but in terms of practical implication, probably we put it at an extremely low probability.
Probability, but of course in the realm of plausibility. Mitali, you were talking about how consumer sentiment is likely to get a fillip with this 50 basis point cut bonanza. But the point really is that for whatever reason, and we know the reasons actually, it is net interest margins, but banks and NBFCs choose to transmit the cut in interest rates. They take much longer to transmit those to consumers as opposed to when there's a hike. But despite that, we are seeing there is some momentum in auto stocks this morning. Maruti Suzuki is up about 1.2%. M&M is up about 0.5%. Tata Motors is not reacting really to this rate cut announcement just as yet. But it does seem that auto stocks and going forward, perhaps even housing stocks is where there is likely to be some momentum. But again, come back to the transmission challenge. How soon can consumers expect relief on their loans?
No, absolutely, Kartik. I think we are going to start seeing banks transmit this much sooner than they previously have, because of the simple math that they have to do. That at the end of the day, the main reason this second rate cut, has been delivered is to boost consumer sentiment. That's one. And to boost private investment. And this private investment saga is something that we've been looking at for the last 5 to 8 years, where the government has tried many measures to boost private investment. And this is the time where they have been actually having roundtables with a lot of industry players. They've been speaking with CII, they've been speaking with FICCI, and the Ministry of Commerce is leading a lot of this dialogue. And it has been agreed that there will be a massive push in domestic private investment, because
Right.
domestic private investment is the one engine of the economy that has not fired
Right.
as fast in the last decade. So
Especially in the
now
urban
with this
areas,
rate
while
cut.
we've seen some recovery, and that is something Sanjay Malhotra also mentioned, that we have seen recovery, steady recovery in the rural part of the consumption story, but the urban part is yet to fire on all cylinders.
Exactly, Karthik, and that's quite a conundrum, isn't it? Because at the end of the day, the rural consumer can only drive growth so much. The amounts and the levels are still far lower than the urban consumer. So what
Right.
we're starting to see is a little bit of an inequality that's creeping in, to our growth story, and we need to correct that, and we need to take those measures now. We
Right.
need to start seeing the tier two, tier three, tier four real estate markets pick up. We need to start to see the tier two to tier four consumption expenditure pick up. And with this rate cut, this is one of the levers to actually deliver on that.
All right. Vivek, GDP growth forecast staying static at 6.5% despite a solid 50 basis point reduction. No change really in the forecast of GDP, coming, of course, on the back of what we saw as a surprise, not a positive surprise, on how FY25 ended compared to the 9.2% of FY24. FY25 ended at just 6.5%. The same assumption, the same forecast which was stated in April continues to be true at 6.5% for FY26. Is this in line with your expectations?
Yes, so pretty much. So, but before we talk about GDP, just a quick mention of another announcement from the RBI which has come, which
Right.
is a 100 basis points reduction in the CRR.
Oh,
So
okay.
it's like whatever was in store has been delivered in the June policy review. So you have a 50 basis points rate cut, you have a 100 basis points reduction in the CRR.
Right.
And now the governor himself indicated that the room to support growth incrementally is going to be very limited. So he's in some ways indicated that he's justifying the neutral stance. Now, getting back to the growth angle, we at QuantEco also believe that growth is likely to be very much similar in FY26 vis-a-vis 25, and our projection is at 6.4%. So it's pretty much in line with what the RBI is expecting. Now, all of us know that there is a great amount of global headwind, which we anticipate in FY26. That's true. There is nothing that we can do about it. We could possibly renegotiate our terms on trade, get into slightly more favorable agreements. But these are medium-term steps that the government will involve itself into. Now, from a macro perspective and from a financial year perspective, we also have to look at what's changing if external sector is turning adverse. What's actually compensating is the likelihood of a normal monsoon. And on a back to back basis, you will have support from the rural economy. The RBI interest rates rate cut has happened at a very short span of time. So if you compute between April and June, that is just about a quarter,
Yeah.
the interest rates have gone down by almost 100 basis points. So you have 75 basis points rate cut in the form of repo. You have immense amount of liquidity infusion, which has led to a shadow rate cut of 25 basis points.
All right.
So within 3 months, you've got 100 basis points rate cut, which will pass through or in fact trickle down to the rest of the economy within a span of 3 months. Probably it can happen even earlier because now it's backed by 100 basis points
All right.
CRR cut.
Right.
So this monetary policy transmission should also start supporting your urban consumption. So
All
on one
right.
hand, you have external sector which is adverse. On the other hand, you have a recovery in consumption demand aided by a cyclical factor called monsoon and policy support from the.
All right. So inflation target now, CPI inflation target, Mitali, at 3.7% versus 4%. And of course, like Vivek was mentioning, the monsoon months are going to be critical to understand. But overall, despite this revised, lowered projection for inflation, the stance being changed to neutral is a little mind-boggling. How do you simplify that? And overall, how crucial is Q2 going to be for the overall inflation print as well as the overall GDP forecast?
So, Kartik, lots of points there. I'll just break it down into a couple of reflections. The first one on inflation. I think, when we are looking at each year when you and I speak about this, we often say, why is it that the investments were not already in place before the monsoon season came in for climate resilient infrastructure,
Right,
for
because that
making
is the
our supply
fiscal
chains.
policy and not the monetary policy, and we end up discussing this only around the time of a monetary policy.
Exactly. But at the end of the day, we are talking about a whole economy, and we have to think about the fact that we need more and more investments in our cold chains. We need more and more investment in the logistics infrastructure. Of course, each year this is improving. It's not as though it's not improving. We know that a lot of states are now investing in silo bags, for example, for the storage of large amounts of wheat and rice crops. And we also know that with the PM, yojanas, the different, grain distribution schemes, we've seen that a lot of that grain gets distributed, and that helps households manage inflation, which is a major reason why this target has been reduced.
Right.
So we are seeing some movement, but I do feel like we need to start doing much more predictive analysis of the monsoon in order to understand how much this is going to impact and which other supply chains is going to impact. The second point on the neutral policy stance, I do think that it is a very practical idea to keep a neutral monetary stance simply because we don't know what is going to happen with the president of the United States. We really don't know what kind of announcements are going to come with respect to the tariffs. We don't know the direction that we are taking on the India US trade deal, how long that's going to take, how that's going to impact our trade projections. And that is something where for making trade financing more affordable, it becomes important for us to keep the stance at neutral, because tomorrow if there are certain global trends that come in which affect the dollar rates, we have to immediately go for maybe a rate increase as well. And finally, on the GDP projections, I would just say that no, at this point in time, we should always be very thankful that the Indian economy has provided, a petri dish for the whole world to come and see what happens when you have decisive leadership. We just had the show that we did a few days ago on 11 years of Prime Minister Modi's leadership. And I really feel that the fact that the velocity in the decision making has been so fast, we've had clear policy direction and guidance, which has been consistent for a decade and more. And we now have, a plan to move into newer directions on better technology, on semiconductors, on electronics. We have the production linked incentive schemes. All of these ideas are working, and that is why we're on this growth path. If it was not for these ideas, if we'd had a policy vacuum, we would not be on this growth path. So I think on the growth path, I'm less worried. But I am worried about the growth distribution, and for that growth to be distributed much more in tier 2 to tier 4 cities as opposed to just tier 1 cities, and then some backed by rural consumption. So I think this decision today will aid that process.
Right, Mitali. Well, I will let you go on that note. Thank you so much for joining us here on News 9 this morning on this very important announcement day. Vivek Kumar continues to be with us. But before I come with my next question to Vivek, let's just listen in once again to that massive announcement made by Sanjay Malhotra just a few minutes ago. Let's listen in to what he said on the repo rate cut.
The Monetary Policy Committee met on the 4th, 5th, and 6th of June, that is today, to deliberate and decide on the policy repo rate, and after a detailed assessment of the evolving macroeconomic and financial developments and the economic outlook ahead, the MPC decided to reduce, which is widely expected, the policy repo rate under the liquidity adjustment facility by 50 basis points to 5.5%.
Right, so that was that massive announcement coming, 5.5% being the new interest rate, the new repo rate announced by RBI Governor Sanjay Malhotra. Just a few minutes back, we also now have a market guest joining us. Kranthi Bathini is with us this morning on the show. Kranthi, good morning. Pleasure having you as always. Help us understand this announcement that has come by way of the CRR cut by 100 basis points. The banking stocks really seem to be rejoicing on that announcement. HDFC Bank is up about 0.7%. Bajaj Finance, in fact, is up almost 2.75%. Axis Bank is up about 1.6%. SBI, Kotak both over 1% in gains this morning. Kranthi, what are you making of this announcement, and what does this really mean for banking stocks from here?
Hi, Kartik. Yeah, I never witnessed such a very aggressive monetary policy from Indian Reserve Bank in the recent past. Very aggressive, and it's a pro-growth measures what they have taken. Definitely, it supports the growth of the economy because of a lot of uncertainty was prevailing in the global markets at this point of time, reducing key monetary measures, CRR 100 basis points, and the key interest rates to 50 basis points, where the consensus view was around 25 basis points. It definitely, the RBI MPC committee surprised the street this morning. This will help the banks to increase their NIMs and credit growth, banks and NBFCs, and also interest rate sensitives like the autos, real estate, and these are the direct beneficiary. And also this will help the growth to further regenerate in the coming quarters. It's a very welcoming move, Kartik.
Welcome move and should augur well for the economy. In fact, the News 9 edit that we released this morning was exactly pinning its hope on this very decision by RBI Governor Sanjay Malhotra, asking for him to bite the bullet and double down on the repo rate cut to 50 basis points, and that's exactly what we are seeing this morning. Vivek Kumar continues to be with us. Vivek, I want to understand now from you, how does a rate cut, such a massive rate cut of 50 basis points, now align with what else we are seeing in the world? So, for example, yesterday the European Central Bank did cut interest rates by 25 basis points, but the US has been absolutely static. We've seen no rate cut despite the pressure that Donald Trump is trying to put on Fed Chair Jerome Powell. So, in the overall scheme of things, especially in the context of foreign flows coming into India, which is also something that Sanjay Malhotra just spoke about, now how does this rate differential, yield differential really pan out for the Indian economy?
Well, to put things in perspective, if you see how markets have reacted, when I say markets, the interest rate market in India and the foreign exchange market, which are more attuned to what the governor has announced in the last 30 minutes or so, they're absolutely flat. And bond markets, they initially rallied after the 50 basis point rate cut. But as soon as the statement came that the stance has been changed to neutral, all the gains were given back, and the markets are currently absolutely flat. And the similar outcome is seen in case of rupee movement. So globally, if you scan the surface, the picture that emerges is pretty diversified. And what the ECB did yesterday was they did meet market expectations with respect to a 25 basis point rate cut. But similar to what RBI said in terms of their stance, the ECB press conference also tells you that now they are at the end of their rate cut cycle. And that's why probably the currency started to appreciate. The interest rate yield or the bond yields in Eurozone actually moved up despite the 25 basis points rate cut by the ECB. And most of the other developed countries' central banks are also approaching the end of their monetary policy easing cycle. As far as Federal Reserve is concerned, they had last indicated scope for a 50 basis points rate cut. And this was for the calendar year 25. This was in the month of March. Their updated forecasts will be available in June policy, which is just a few days away from now. And the expectation is that they are going to stick to that 50 basis points projection of a rate cut room for 2025, despite the political pressure that the US administration, the Trump administration is putting up. And the reason why they will probably stick with that 50 basis points rate cut scope is there is still a little bit of slack which is there in the economy, which needs support. And although there has been some bit of inflation relief, but there are also upside risks which could potentially emerge from the tariff negotiations which are going. There is an extreme amount of heightened uncertainty because of this, because you might picture in a certain magnitude of tariff and bake that into CPI projections, but you don't know how it is. Is it going to be durable? Is it going to be retracted? Is it going to be doubled down upon, like we saw in case of steel and aluminum just about a week back? So this uncertainty is leaving that projection exercise extremely challenging. We can empathize with the Federal Reserve. We are dealing with a similar kind of situation ourselves. Not just, I mean, we're not talking about CPI inflation in India, but with respect to spillover impacts that India could possibly face.
All right.
So, given this backdrop, I think it's best to stick to what you said earlier and start calibrating policy as and when data arrives. So if there is clarity on what the US is doing on trade, you can obviously fine tune your interest rate trajectory of monetary policy in later. So without giving any surprises on either positive or negative side, I think it's
Yeah.
best to stick to what you say and then calibrate according to what the signals you receive from Washington.
Absolutely. Well, Kranthi, we are looking at markets right now, tracking them for our viewers, and Sensex, Nifty both more than 0.5% up. Nifty 50 is in fact up almost 0.6% in trade right now. And no surprise, two sectors which are delivering wealth for investors today happen to be the banking sector and the auto sector. And we are seeing massive gains there. But for some reason, we are seeing, Tata Steel is down about 1.4%. JSW Steel is up about 1.8%. So, there's also this little bit of a conundrum in the same sector between stocks. So there seems to be some sort of a domestic demand versus global demand and tariff also being played out in the markets today. But overall, it does seem like a good day for the markets and something which by way of policy announcement is going to augur well for investments going forward, isn't it?
Yeah, yes, Kartik, you're absolutely correct in terms of you raised the very good, interesting thing, difference between the Tata Steel and also the JSW. Of course, Tata Steel have a larger exposure to the global markets, and JSW have more exposure towards the domestic markets. That's where the market is behaving in such a way. But by and large, the policy measures which the market, the MPC, RBI government, RBI has made, it's really surprised the market in a positive way. And that's how what we are witnessing is market is slowly inching towards the 25,000 level. That's what we are witnessing in the market at this point of time. By and large, it's a pro-growth kind of a MPC committee that has delivered these kind of rate cuts, which is positive for the markets.
Vivek, Kumar, before I let you go, one final question to you, and this one comes specifically again an announcement that we heard from Sanjay Malhotra that India's non-gold and non-oil imports are also showing robust demand, and this is again something which seems to be at a sort of crossroads of, are imports good for the economy, are imports bad for the economy? Because when we are talking about GDP growth, we don't really want imports to be robust, we want imports to be lesser as compared to exports. But when we talk about the trade deficit, then of course you don't want imports to be good again. But the fact that it also denotes that there is greater demand, which means there is more spending capacity for those imports to happen. How do you explain this to a layman?
So
Kartik, this
it's a difficult one. You put it very simply, but I would say that so from a trade deficit perspective for an emerging market like India, what matters is what is the color of that deficit? Is it more consumption oriented? Is it more investment oriented? If the deficit is predominantly on account of consumption oriented goods, then you have a little bit of a concern. The concern is valid as long as you are not sure about how to fund that deficit. That's the other angle of the concern. Now, if the deficit is predominantly on account of investment-oriented goods or goods which is actually good for the country's long-term potential growth, then there are less reasons to be worried. In fact, you could actually encourage that sort of a deficit through other means, and try and make sure that an investment-oriented deficit actually gets funded easily by calibrating monetary policy as well as fiscal policy to ensure the financing. Now, what is exactly happening in case of India currently? Well, it's a good mix, I would say. So you have on one hand a deficit which looks like to be consumption oriented. At the other end, you also have a deficit which is supporting your investment. So there are various intermediate goods which enter the trade deficit through, let's say, countries like China, countries like US, countries like continents like Europe, and that actually helps in supporting economic activity. And in fact, there is a fair degree of re-exports which are linked to the imports that you do, which actually helps your export market also. So having a sense as to, I think it's better to look at the aggregate picture, and the aggregate number is still looking like it's going to be less than 1% national GDP. Whereas the long-term average for India's current account deficit is closer to 1.5, 1.6% So we are undershooting that trend, and that's a relief, I would say, in the current global environment, because in the current global environment, capital is going to be scarce.
Right.
So if you're keeping your deficit below your long-term trend, then you could be in a better situation to fund this.
All right. And one final question to you, Vivek, and this one comes on way of oil and oil prices globally, which again becomes a very, very important parameter to take into account when we talk about India's growth. Now, till about 8 months, 9 months back, all of last year, we wanted oil prices to remain below $100 a barrel. And right now, we are assuming that for India, oil prices remaining in the range of $60 to $65 a barrel is going to deliver growth. Now, the point really is, if Russia decides to retaliate, if globally, again, we see that there is going to be a spike in oil prices and oil prices do breach that $65 a barrel, how much of a threat do you anticipate that to be for India's growth?
Well, the threat is always there, but in terms of how much devastation it could potentially cause, well, it's something which would be in the nature of conjecture if one would do so right now, because whether oil prices would move up by $10 or whether they would move up by $30, it's hard to predict at this point in time. However, having said that, we can take comfort from the fact that oil prices remaining at 65 is a collateral benefit of the global slowdown that we've been talking about. So while yes, there is global slowdown, but it also reflects in lower oil prices, which actually helps your inflation picture. Now, if let's say prices were to escalate on account of geopolitical concerns, and if you move towards $80 would still be a level where India wouldn't mind uh, it to be, because $80 still seems to be the comfort level or the sweet spot where India could manage its domestic macros much more comfortably.
All
The
right.
problem will start when you have oil prices in triple digits.
Right, of course. Well, I think there's still some way to go before oil prices do hit that triple-digit mark. But Vivek Kumar, thank you so much. As always, pleasure having you here with us on News 9. Kranthi, I want to come back to you on markets specifically. And now the view really seems to be that with this 50 basis point cut delivered and with growth projection unchanged, at least there's no negative news on the growth projection, there seems to be a moment where we could expect some foreign flows to come into the Indian stock markets, but because of the differential between the interest rates and the yields that the US bond market risk-free investments will deliver versus what the Indian bond market will deliver, it seems that perhaps India's debt market could be under pressure. Is that a right assumption to take at this moment?
Yeah, little bit of debt market can be under pressure, but the primary thing is okay. Of course, one hand the government want to balance and increase the exposure of Indian debt market. They want to take it to the more favorable to the international market, but at the same point of time, the other hand, we should not compromise the growth when there is a looming uncertainty across the globe. Kartik, RBI have taken a very interesting measure. It's quite surprising to the markets, even for the debt as well as equity markets also. They have their prime objective is to sustain the growth and take the growth measures going ahead. That's the reason they have taken a very aggressive measures. I never, in the recent past of my memories, okay, MPC is have a tendency to disappoint the investors always, but this MPC is something different. They completely surprised the investors on a positive note. They have given a bonus to the market
Yeah.
this time.
Right. So last so many times that we've spoken, Kranthi, we've said that, and especially on days that markets have been flat, I think we've always come to agree on the fact that there's a missing positive trigger for stock markets. And everything what was happening domestically and globally was pretty much on expected lines. Even the uncertainty arising out of what is happening internationally, especially with Donald Trump, was yet on the expected line. So is this finally that positive trigger which will have a lasting impact on Indian equity markets?
Definitely, Karthik, definitely. RBI have taken, because perennially we have a tendency. If you see the history of RBI monetary policy, okay, they always try to maintain a very tight liquidity measures, despite of the loose monetary policies, zero interest rate policies across the globe. RBI have a tendency to maintain a very strong. Stringent liquidity measures. That's what RBI tend to take. But this time, due to the different factors and the uncertainty that has been raising across the globe, when the Federal Reserve is sitting strong, tightly with their monetary policies, the Indian RBI, the central bank, went out and taken these kind of decisions. Really surprises the market at this point of time. Even in fact, the global investors also.
All right. Well, of course, a positive surprise there and a positive trigger, the much awaited positive trigger. Kranthi Bathini, as always, pleasure having you. Thank you so much for being here with us
Thank you,
on
Karthik,
this very
always.
special announcement of the MPC decision day. And meanwhile, markets, of course, are reacting positively. The banking stocks and auto stocks are both rejoicing the bonanza of a 50 basis point reduction that Sanjay Malhotra has just delivered for them. Well, we will leave it at that this morning. As we speak, Nifty is nearing that 25,000 level, while Sensex is comfortably above the 82,000 levels. This morning, volatility in the market is low, down to just 14.84. Well, let's hope the momentum continues. And with that, it's a wrap. Thank you so much for watching. News, of course, continues right here on News 9.